Hi and good morning, everyone. It's 9:02, so let's get started. Welcome to our webinar, It Ain't Over Till It's Over. I'm Mona and I'll be your moderator today. I hope you're well settled with maybe a nice cup of tea or coffee and are ready for an economical update on a Friday morning. I would like to share some practical information with you before we start. So I will share my screen. I hope you can see my screen now.
Yes, you can, Mona.
That is good. Okay, so if you have any questions today, you please feel free to ask them. You can do that by opening the menu bar, and you do that with, you can see that little orange button you have with the white arrow on it. If you click on that, the menu bar is open. And if you scroll down, you will see you have this gray field with questions on it right here. And you just simply click on that little white arrow and this area is opening and you can type in your question and submit it to us. And all of the questions will be answered at the end of the session in our Q&A part. And also today's webinar will be recorded, and the recording and also the presentations will be made available for you a few days after the webinar. And then I would like to introduce today's speakers. You will meet our CEO for Coface Nordics, Pekka. He will have a short introduction. And our next speaker, if you have followed our previous webinars, she will be familiar to you. It is Christiane von Berg, which is Head of Economical Research in Northern Europe. She will go through the presentation, It Ain't Over Till It's Over, together with our new economist, Johansen Steenberg. As you can see, Johansen is situated in the UK, but he will still cover the Nordics going forward. And I guess he also has a special interest in our region, being Danish of origin. So with that said, I think I'll leave the word and floor to you, Pekka.
Thank you, and good morning from my behalf as well. It's really nice to see a record amount of attendees in our first webinar of the year. First one of many to come, so we will be having a lot of webinars this year on various topics, and I hope you will enjoy all of them. I'll just give you a quick introduction, maybe looking a little bit back towards the start of the year. It has been a really busy year for us in Coface, but I would say probably to everybody working in trade, domestic or exports. Quite many of the topics that we discussed in our last webinar end of last year has still prevailing. Inflation is staying on a very stubbornly high level, still increasing year on year, month to month in our region. Similar to that, the central bank activities hasn't really stalled. Interest rates are being increased, which obviously means that the funding cost of our clients and their clients, and frankly everybody having a debt in their operations, are seeing that impact on a daily basis and a monthly basis. Something that has happened and accelerated from last year and the last quarter of last year is insolvencies, specifically in Sweden, but we see insolvencies increasing all of our 4 countries, and most of the sectors that we are more attached to are also seeing increasing levels of companies failing. And similar to that, what is interesting to see that we also have experienced quite an increase in overdue reports. So we see that companies are having a bit more challenges in liquidity at the moment, mainly due to these reasons listed. And also, Something that we are following quite closely is the consumer behavior. In that sense, we see that this is the year when the interest rates will be ticking the mortgages, for instance, in Finland, every single day, every single month, when the Euribor 12 is being updated to the mortgage loans, it will be a significant increase. So we see that the consumers are being squeezed a bit, but so far so good. It looks rather stable. A little bit on a higher level, if you look at the Nordics and the implications that we see from the global world as we are connected, the war is still ongoing in Europe with no or very little, if any, signs of that changing, unfortunately. And of course, we all can witness and read the news about geopolitical tensions rising a little bit between US and China and US and Russia. So it's a lot of elements and pieces in the puzzle that are trying to find their places, and it's relatively difficult to read. Remains to be seen what happens with Sweden and Finland in their adventure to be joining NATO. Maybe the hand-in-hand approach will not prevail, but they will be onboarded individually. Probably Finland being the first one, which is a really interesting thing to follow from economic perspective as well, because there's quite a lot of investments in Finland pending, waiting to see whether Finland becomes a NATO member, decreasing the geopolitical risk of the country, which is interesting to see. So it can actually have a positive economic impact as well. So something we need to follow. Moreover, last 7 days has been a really interesting days to follow also in the banking sector. So we've seen quite a bit of turmoil. Maybe Christiane and Jonathan will touch these topics on their presentation. If I would like to summarize a little bit about the first quarter, 2 weeks still remaining, is that we see a lot more requests to cover trade, which is natural given the risk awareness in the markets increasing, but also the risk awareness being attached to real-term events. So I think it's quite fair to say, if you were following yesterday evening or afternoon, the ECB General Christine Lagarde, she actually said that it's really difficult to say where we are going to go from this point forward. So there's a lot of unknowns in the markets and the economy at the moment. So that is a quite good place to make sure that you are operating with as good risk insight as possible while being protected against the worst case scenarios that we've seen now during the last 2.5 months becoming somewhat more realistic. So more insights and more information is always better, and I hope you will enjoy the economic outlook given by Christiane and Jonathan. So I will mute myself. You probably joined to listen to them more than me, so I wish you enjoy, and I will hand over the stage to Christiane and Jonathan. Thank you.
Thank you, Pekka. Jonathan, you're there.
I'm here. I'm awake and on.
Great. Well then, welcome everybody to our part of the webinar. I'm so delighted to have my colleague and already good friend Jonathan with me. As Mona already said, he will take over the Nordics, so a bad and a good news for you, because this presentation is also the reason where we show you why Jonathan is far more better than me regarding everything concerned Nordics. But before we go into the topics of Nordics, we start, of course, with the general stuff that we always talk about, our bread and butter business, country risks. So we have a new country risk map set up. Now it's March, so let's have a short look on it. First of all, we shortly want to recap what are country risks. So please remember, we are not a rating agency. We are not Moody's or Fitch. What they are looking at is country risk in terms of the risk of a debt default of their public debt. But what we are looking at is the probability of a default of an export credit in a certain country on the time horizon of 6 months. So we are looking at a whole bigger scale, I would say, at least. Jonathan, what would you say here? Or
I'd say it's pretty good.
thank you. So what we are looking at is we have different parts here included: macroeconomics, of course, also public risk, yes, banking risk, payment survey or payment risks that we have, of course, the general environment of business. So how good can you do business in a country? I mean, yes, in the Nordics, it's not a problem, but looking at other countries, corruption is a big topic there. And then we have, of course, environmental risk and something that I missed.
I think you covered most of them there.
Okay, good. Well, then
I think some governmental and institutional risk could also be thrown in there, but again,
yeah, there's so many risks. True. So what we have a scale system from A to E. A is very good. E means that we are actually not covering this country anymore, and you see that A is quite a bigger area. So we subdivided it in A1, A2, A3, and A4. So what are our changes in the last time? We had some upgrades. Yay! First time I feel like that we have upgrades. The upgrades are concerning India. India is doing way more better now, economically speaking. They are a little bit behind what we in Europe are doing. So what you see is the economic or positive economic development is more or less the reopening of the economy after the pandemic. We had that roughly in 2021, early 2022, but they are a little bit behind. And then this country that's Burundi, correct?
Yeah.
Burundi has an upgrade now coming from E to D, means we are covering it. The reason behind that is that the US has let them go from their sanction lists, and some reason is that it calmed down before they had violated some peace treaty in the region. And also we had the very first step that the power went over in a peaceful way in Burundi, and the first time since its independence. So yes, here in Europe, nobody is cheering if there is a peaceful transition of power from one government to another one, but Africa is there different, and Burundi has done it, so at least they get it deep. Then we have 3 downgrades. One is here Ghana. Ghana is doing not so well right now because they needed more support from the IMF. The IMF said, yes, we can give it to you, but only under very certain, very restrictive measures, which means a lot of austerity policy, and that's taking down economic growth. So from D to C, we have Peru. I think that came up in the news a lot with the turmoil that the former president made some kind of coup d'etat and wanted to close down the Congress. The Congress then took him out of power, and then it actually, if you think Borgen was really strong when it comes to politics, Peru would be a whole big thriller when it comes to politics. So that was interesting. And then we had Haiti downgraded to E. The reasoning here is that since the assassination of the last president, which was already in 2021, there is really some kind of power vacuum there. And the violence got such a high level that we said, okay, that's not safe to do any trade there. So E. This is it. You see that in our region, nothing big has changed. You are from Denmark. Jonathan, do you think A2 is the second best grade that we have? Denmark versus Norway. Is this reasonable?
I think Denmark versus Norway is reasonable. As long as we're not doing worse than Sweden, I'm okay.
Okay, good to know. I think we will talk about that later on, but I guess one reason why we see right now our region a little bit different in the kinds of shades of green is the GDP, and What would you say about that, Jonathan? Can you give us, please, some kind of insights here?
Yeah, before we go into our forecast for next year, we sort of want to give this overview of what has happened since COVID. Where are we right now at the end of 2022? So as you can see, generally speaking, the Nordics and many of our main trading partners saw a roughly similar development. Big drop in 2020, a somewhat recovery in the latter half of the year, and then during 2021, most countries either returned or even grew compared to the pre-pandemic levels. And then since the invasion in Ukraine, we saw a roughly stagnating level of GDP. So while you might see large increases year on year, this will mainly be due to a lower first half of 2021 compared to 2022, because as you can see, the overall growth kind of slowed down during 2022. So those are sort of the different steps we saw here. There are some exceptions in the last quarter in which we still have strong growth in some countries, as the US, Netherlands, and Denmark in particular. Denmark, it should be said that this is also largely due to a lot of investments in the last quarter, which really pulled this up to a high level.
So why are the investments so high? I mean, 0.9, that's a thing.
It is a quite a high one. I think it can be one of two things. I personally believe it's mostly investing early for what's to come. So we have a lot of energy pricing going up, which means investment towards energy efficiency will make a lot of sense. So maybe this is slightly front loading from something that could be difficult going forward. And we are seeing this in other countries as well. UK saw a similar thing, which also is partly due to their capital deduction rules changing, but it's a bit of front loading. No, but if you remove investments from the UK, the picture was even worse.
Oh, okay, good. Well, I can say from the Netherlands, who are with 0.6, it has nothing to do with investments, it was partying. Yeah, sorry, it's really like that. It's consumption, and it's service consumption. And I mean, if you were there during New Year's Eve, you would have seen fireworks everywhere. The Netherlands were on fire. So that's the story of the Netherlands. Okay, but we see also that there are countries who are doing not so well. So like Finland, like Sweden, and also Germany. Can you tell us what's going on there?
Yeah, because I think what I hope we both agree on here is the surprise is not as much that these countries are doing badly, but more that the rest were doing surprisingly well. Since the last half of 2022, the situation in many countries have been difficult, with high inflation figures, at some point having to eat into consumption, what Pekka mentioned earlier. However, what we have seen until now is these excess savings from COVID really actually meant that people kept on consuming to a large degree. But at some point you have to pay the piper. And I think what we're seeing in Sweden and Finland and Germany is actually what we can probably expect to see in other countries, which is more a reaction to the macroeconomic environment. I'm not sure if you agree there in Germany, but that's at least what I'm seeing in Sweden and Finland. It is actually a response to the economic situation.
It is completely for Germany too. Actually, I was really surprised the very first time, in Germany, we are publishing the GDP numbers 3 times, the first, the second, and the third. And the first time it was 0. And I was like, what? Were we so good? I felt it different, but hey, I mean, I'm not the one complaining. And then next time it was minus 0.2 and my mood get down, and then 0.4. And I thought like, yeah, great. But yeah, this is how it is. I mean, what does this mean now for GDP growth for this year in total? First, maybe let's look at the global picture, what we show here on the left-hand side. This is economic growth and its contributions by the United States and advanced economies without the US, and the same with China. And you see that, yes, of course, this is the deep down dive from the pandemic, then the strong recovery, catch-up effects, we call it in economics a rebound. So everybody who's familiar with basketball knows what a rebound is. And then we have lower growth here. So we are now at 2%. And if you are comparing that with the last decade, you see that 2% is really lower than what we saw before. So that's definitely lower. And if we are looking, where is this growth coming from? It's really China and emerging markets. It is not coming from us. And I think it's clear when you look here at the single side that, yeah, it's no wonder. I mean, many of the countries we are looking at here, Germany and here the Nordics, have maximum, yeah, stagnation. Now 0.2 is stagnation. I would say that plus 0.1 and minus 0.2 are both stagnation. I mean, it's a question of mathematics if you are above the zero or a little bit below. But Sweden is definitely suffering here, minus 0.5. So yes, we can say from our side there is not really growth coming up, except maybe for Norway.
Yeah, and Norway is obviously, in certain degrees, it has been a different animal during this crisis, as it is a big exporter of natural gas and oil, which has seen a lot of it rises in prices. I know you're going to go into that in a second, but also if we look at the inflation figures in Norway, it has been a lot lower than many other European countries. So in that way, Norway is a standout, and that's also why, that compared to many countries, it is seeing this stronger growth. And I will say, while the Danish figures of 0.1, and this is as Dane, I have to mention that seems low, we have to take it with the caveat that we have seen a lot of growth since then, and this stagnation is also some base effects. We're coming from a high level.
Yeah, okay, we got it. Denmark is great. But what I wanted to say here or to add is also that Norway, and I want to remember everybody, is the only country that we have in the total world which has an A1 grade from us. So the only A1 country is Norway. We have it in the Nordics. I'm proud. Although I'm not Norwegian, but I'm proud. Yes, we wanted to talk about energy. I mean, that's of course the big question mark that we have in especially Western Europe, Central Europe. What is our energy supply for the next winter? I mean, this winter is gone. We are already in spring mode, although sometimes I'm surprised that we have snow outside right now. Nevertheless, what has happened is, you know, that we in Europe, especially in Germany, are staring every single day at the gas storage numbers. It's a little bit like World Cup in football. Just that we have it now for almost a year. We see where we are right now, and these are the gas storage fillings, our 2023 numbers, 2022, 21, and this in gray is really the channel that we used to be in the last decade. And we see we are definitely here at the upper front. We were a little bit in December below because it got unusually cold. So yes, even I took on my heating a bit more. I am trying to work with the numbers that the Federal Ministry of Economics is giving me, but sometimes it's really too cold. So I heat a little bit more, but you see, since then we are really here at the upper front. Nevertheless, of course, right now storages are decreasing, and then normally in April there is this strong increase. You see it here. It was really fast last year, but please keep in mind that until August Russia was still giving us gas. So Russia is now out of our equation. What we see, for example, in Germany, one of the countries who needs the most gas, first of all, because we are really big, we are the most people for one country, and also because we have the biggest industry, so not really helpful. And this means that we are, of course, looking where gas is coming from. First of all, greetings to Norway, and thank you very much for all the deliveries you're sending. I know it's more than usual, and we appreciate it really a lot. Also, the Netherlands and Belgium are giving us more. Unfortunately, the Netherlands will reduce its gas exports because they were closing down right now the gas field of Groningen because of earthquakes related to fracking. And that means that, yeah, the next time, there will be not such a strong increase, so probably it will be something like that here coming up. If LNG is coming more in, if we can use it more, if Norway is sending as much as it does right now, but it will be really close thing. So this is why we say we are not out of the woods. Nevertheless,
No.
for now, we are quite good, and that's something that you see also in the energy prices for Europe. The natural gas price from the Netherlands, it has come down quite a lot. So we are right now still at an elevated level, but nothing compared to what we saw most of the times here in 2020. This year is an exception because that was overcapacity on the market because everybody was buying and it was too much for some single time. But when you look at it, we are now roughly at the level of mid-November, but that can change very fast. You saw it in the past. Every time that we see scarcity, people are running to the markets, buying everything they can grab, and that is keeping up the prices. So again, please be prepared that next winter energy prices, and that means also inflation, could jump up a lot. And when we are talking about inflation, of course, we want to jump into the latest numbers. Can you give us some insights here, Jonathan, please?
Yeah, definitely. So I know you guys heard a lot about inflation in the last year, maybe in the last 2 years, depending on your friends. And I promise we will probably keep talking about it for the next year or so as well. And the reason you can see is when we look at the graph on the left, we have the last year's inflation, the latest value, which is the February numbers, and then the 2023 forecast. We've also here added the average for the last 5 years before 2022, as well as the 2% target that most central banks have. And as you can see, most of us have been very good at being around these 2% in the last 5 years. Some of us have even been having a hard time reaching the 2%. I still remember working in the Danish finance in 2015 when oil prices were falling and we were afraid about deflation. And that was the only thing we were talking about. But the world changes quite quickly. And as we can see, while we had quite a high level, for most of them, the last figures are either around or they're coming down, with one exception, which is Sweden. And we'll get to that soon. You can see the Swedish level in February 2023 is still quite high. One of the reasons why we really focus on inflation, and one of the reasons why it has a big effect, is what Pekka was saying earlier. It's about what we can consume. And if we look on the right-hand side, we see the graph for the nominal wage growth. So again, what we're being told by our boss we will get, and then also the real one, which means you remove inflation from it. So what does it actually mean for you? And as we can see, average nominal wage growth was generally slightly higher, with the real one being around 1%, except for Germany. I'm sorry, Christiane, where it was about unchanged for the last 2 years.
Yeah.
I'm not sure if you can relate to that. So what we saw.
Yes, I will.
So what we saw in 2022 was generally nominal wage growth was slightly higher than the previous years. But when we look at the inflation for those years, in real terms, people's real disposable income actually came down. Now, one country did see a fall, but it was less so, and that's Norway, again, to support why Norway is generally in a bit of a better state. That's due to two things. One, its nominal wage growth was slightly higher, and two, inflation figures in 2022 were also lower, which means they only saw about a 2% fall in their real wage. But if we look at the three other Nordic economies, Finland, Denmark, and Sweden, this was quite a different picture, at least a 4% fall, which is quite a lot, meaning you can buy in real terms 4% less than you did the year before. Now, this at some point will start having an effect on your disposable income, on your consumption habits. And what we saw in 2022 was this was partly true, especially in Denmark. We saw private consumption falling quite a bit, but the Netherlands story from 2022 we saw in Denmark in 2021. Denmark went out gun blazing after COVID, and you saw private consumption reaching quite a high level, which means this gradual fall through last year was one also normalization of what I would call almost a consumption thirst during 2021. But this means that going into 2023, people are, relatively speaking, slightly poorer than before. But the reason why we also have the forecast here is that this won't necessarily change. We luckily have collective agreements in the Nordics, and we have some of them being finalized in Denmark and in Finland. And what we're roughly seeing, and I won't go into too much detail, but that is 4 to 6% is a pretty good average for what people are expecting to see nominal wage growth. Maybe towards the lower end for some, and towards the higher end, especially for lower income jobs. Sweden and Norway are still negotiating, but what many of the unions are arguing for is between 4% and 5%. So if we look at that range.
Sorry to interrupt you, but this means that in all of the Nordic countries, it will be that you have still a negative real growth in 2023, or?
Yes, exactly. We might see Norway just barely making it, that some people will see their real wage being roughly unchanged compared to the year before, but then the year before was also a decrease. But one country that should hopefully stand out here, and it's also why we are slightly more pessimistic for Sweden, is that Sweden saw the largest fall last year, but it's also going to see the largest fall this year because inflation is more sticky. And currently the wage they're negotiating is actually slightly lower than some of the Nordic peers. They are, at least more of the unions are closer to 4 than 5, and Finland negotiated 6 for some of them. So they are on the lower end and seeing high inflation. So that means real wage and real disposable income in Sweden is something we are quite nervous about going forward.
Okay. I have another question. I mean, we have here lower inflation rates for actually almost in every single country, except maybe for Germany, between 2022 and 2023. Still, we are talking about higher prices. How does this make sense?
Well, I mean, it makes sense in a lot of ways, and I think the next slide would probably be the nicest one to explain this in a sort of quite an easy way.
Here we go.
Which is the fact that many countries in Europe saw a relatively similar to Denmark change in their prices. Inflation kept on rising until September, October, and then after that it started coming down slowly. For some countries slower than others, but generally as energy prices peaked, and we saw Christiane present that with gas prices before, that was really pulling up at a certain level. And after that, as energy prices started coming down, this meant that inflation generally came down a bit, and from the next few months we'll see what we economists call base effects, which is the fact that we are at a high price level means that relatively speaking the level will be lower. So the base effects will also help push down the inflation level, as well as we had this sort of fall in energy prices. And generally, as you can see between Sweden and Denmark, it's a similar picture. Energy and transport came up as fuel prices also rose, and this translated into almost everything else. Food saw a lot of increases, which is energy intensive and very sensible to the war in Ukraine, as they're large food producers, both Ukraine and Russia, and that translated here. But as that slowly translated and started coming down, this trend is slightly different in Sweden. And as you can see, the big difference is these red blocks. And those red blocks, exactly, like that's quite impressive, especially when you think that is mainly coming down to mortgages. And the reason why there is this big change, and there's something Pekka said that maybe we'll start seeing slightly more in other countries, but is that Sweden is far more used to using variable rates on their mortgages, which means when central banks, and Christiane will come into this, started raising these, they're in quite a difficult situation because they're increasing rates to battle inflation, but they're still also causing inflation in somewhere Sweden where it will hit them quicker. But I think, Christiane, you have some good points about what's been happening with central banks.
Yeah, so after we talked about inflation, and I think what we can take with us is, yes, inflation rates are coming down, but it's a mathematical reason. It's not because prices come down. It's just that this year prices are not increasing as fast as last year. So this is why right now central banks are, of course, still in the mood of hiking rates. But let's face, first of all, what's going on in the world of central banks. And this is what we see here on the left-hand side. We see here just the number, the pure number of central banks who are doing rate hikes or rate cuts. The cuts are here in green, and the advanced economies are in a stronger color than and in emerging more in the pastel color. And you see that, during the pandemic, it was all about cutting. We saw that also in our regions, but then since roughly 2021, the tide has changed. That we are now in this cycle of increasing interest rates, except for some single ones here. The up and downs in total number are coming from the fact that not every month every central bank has a meeting. So it should not mean that we are not hiking anymore or not at the same pace here anymore, but that we are still in hiking. Interestingly, here are some single ones who are cutting at the same time, where you think, inflation is not a topic that is not only related to the Nordics or Europe, it's really all over the world. But we have some single ones here like China, like Russia or Turkey, who want to say, who cares about inflation? Our people are not really freely voting for us or electing us, so we can just push here our economy and take some interest rate decreases. So these are these single countries, and this led in the developed economies really to some kind of, it feels like a competition. Who can be the one who is fastest, who is highest, who is adding something? It's like betting each other a little bit up, and that's what we are looking here at. So basically it all started in the year 2022. So this means that December 2021 is our starting point. We see that some were in the negative area when it comes to the central bank interest rates, the key interest rates. So please, if you are now here looking from the EU area perspective, we're talking about the main refinancing rate and not the deposit rate. If you are confused, why are we starting here at 0? The one who was really in negative area was Switzerland, but now they increased too. And so this means, and I updated it really yesterday. So yesterday is our last point. We have the one who has increased the most income in the total is the United States, the Federal Reserve, by 450 basis points or 4.5 percentage points, followed by New Zealand and Canada and the United Kingdom. So UK are up front. The euro area is now, together with the step of yesterday, which was 50 basis points, now at 3.5 percentage points up. Sweden followed Norway, and Denmark is of course a special case, because in Denmark, as you all know, we have to keep up the peg between the Danish crown and the euro. Japan has not changed, and you could think, hey, what's going on? That they overslept it? No, Japan, as you maybe know, is a country with a long history of deflation or very, very low inflation. So right now they are around 3%, and I think there is the biggest party going on ever at the Bank of Japan, karaoke and all, because they will do definitely nothing to change that, so that the inflation expectations are slowly coming to the fact that this high level of inflation is the normal standard. So this is why Japan says, yep, this is really what we wanted to have, and the rest is trying to fight it here. Another point which is important to understand is, of course, you could say, I mean, technically a main factor for this inflation is, of course, energy prices. The central banks have no impact on energy prices, so why are they fighting it? Well, it's not about the current inflation. They know that they cannot change that, but what they can change is inflation expectations. And as the Bank of Japan is doing literally nothing to change that, so that the expectations are changing from, in 5 years, inflation rate will be at 0 to in 5 years, inflation will be at 2%. It's the same for the other central banks who say right now inflation expectations reach more into the direction of 3%, but we want to keep them with 2%. And what can we do to keep it there? Well, it is action. They have to act. And that's what's going on here. I think in the next slide we see a little bit better also what's going on with the Norges Bank and the Riksbank. First of all, I mean, the situation yesterday for the ECB was of course not easy, because I mean, even if they were not connected with each other, the turmoils with the Credit Suisse and the turmoil of the Silicon Valley Bank and another bank in the US are making financial markets hyperly nervous. If you just say one word at a different part of a sentence, this will be interpreted as something really bad, really good. So you have to see financial markets are sometimes acting before they are thinking. Sorry to say that.
No, I agree with that one.
Okay. So this is why the ECB was really in trouble. What shall we do? I mean, they had the forward guidance set in February, so only 1 month before, to say, hey, we are hiking by 50 basis points. If they would not do that, what would then the message be to the markets? It could have been that while the European banking system is way more better protected and has completely other equity standards, and maybe we will talk about that later, but for now we keep it with that, then we have to say it is not really in trauma, except if bank runs from one bank are bringing down the trust in all other banks, so this would mean bank runs everywhere. So that would be, of course, a problem. But if the ECB would have said now, no, we do not do it, then financial markets could have thought, oh, there is actually a problem in the European banking sector that we just cannot see right now. So maybe act already. So this is the situation where Christine Lagarde was yesterday, and she decided to say, hey, we make clear first, we do what we said, because right now there is no reason why we shouldn't do that. The European banking sector is really in place, but we emphasize if it should change, we have all the instruments ready to do it. And that's why there was an increase, and this is also why our forecasts for the ECB are still quite a little bit higher. So we are now at 3.5%, and we think that there is at least one interest rate hike of 25 in the pipeline, if not another 25 to come. And for the Fed, well, we have to see how it will work out there next week. But for now, in their projections, this above 5% interest rate level at the end of the year is still in the forecasts. What about Sweden and Norway?
Well, so generally speaking, they have been slightly more hesitant in the Nordics, and we even saw the Danish National Bank designed to hike slightly less, not this time, but the previous time, than the ECB. So that has definitely been a bit more of reticence to increase. But if you look at something like the Swedish and Norwegian inflation, core inflation, there is still a bit to fight there. But on top of that, we also have the fact that the Swedish Norwegian crown has generally not been that strong, which means that we do believe if everyone else is hiking, they will have to follow suit not to see a further depreciation of their currency. So it is partly due to internal and domestic reasons, but also quite simply due to trade reasons. You don't want to see your currency depreciate too much, especially at this time, because depreciation of your currency means that you import inflation. So it's more now than ever important to maintain sort of a relatively stable currency, because that can cost you on future inflation.
Yeah, sure. I mean, when we are looking at balance sheets, we have there also programs in the Nordic countries. Here, the example for the ECB, they just started to stop reinvest some of their purchases, of their monthly purchases right now. This means that the balance sheet is actively decreasing by 50 billion here, starting from this March. 50 billion is not a lot. We expect that this could increase a little bit to 45 billion, but you see these are really more very small adaptations to the overall size of the balance sheet. So this is more, more a signal to the market, but not really a change in the liquidity that is in the market. But coming from the central banks more to the different sectors, you know, that Coface is providing you every 4 months now with a sector risk analysis for 28 countries in the world. This is the overview of Western Europe. You see that we have here only 4 different steps, means high risk, low risk, medium risk, high risk, and very high risk. So only 4 steps. And you see that, yeah, orange is dominating the market. We are quite pessimistic everywhere. If you are looking at the GDP outlook, at investments, etc., there is not so much support here coming. One who's still doing relatively well is ICT, information communication technology. Yes, of course, there is this chip scarcity, but still there is also very, very high demand, and we do not see that this demand will falter, especially now with the change in the automotive systems, but also in other parts. And then please remember, we are all waiting still for our PS5. So you see that demand is still high. Pharmaceuticals is also one where we see still better view, although we have seen some decreases because we see that that the states are pushing more and more pharma companies to reduce the prices, and as input prices for pharmaceuticals are of course also increasing because highly related to chemicals, highly related to energy, the margins are falling, at least in some single sectors. Unfortunately, we do not have that for the Nordics, but we will talk about the sectors now in the Nordics when we are looking at insolvencies. But first, the overall look at the insolvencies. Jonathan, how do you see the situation regarding insolvencies in the Nordics?
Yeah, I mean, to be honest, Pekka spoiled a bit of it, but we have generally seen an increase. But one thing I think we need to keep in mind is, one is the trajectory, and the other thing is the level. And what we more or less saw across the Nordics and across most of Western Europe was this big fall in insolvencies during 2020 and 2021. For some countries, this started normalizing during 2022, and for some, it's still lagging behind. Looking at, for example, Norway, we can see that it's actually only in the first month of January that we're seeing them returning to pre-pandemic levels. So despite the fact that we have generally high figures here, the year to date seems like a high one. What we need to keep in mind here is, as I said, the levels. And while Denmark is 24% higher, it is roughly what it was in 2019 and 2020, back when times were normal in regards to insolvencies. Now, this is now also true for Norway. And while Finland is higher than 2019, it's still roughly the same as 2020. And this was before COVID. So this was still a normal month. So I'd say for Denmark, Norway, and Finland, we are back to normal. So the increase that we've seen so far is a normalization of quite a unique situation. Sweden, though, as you can see, is one we are more worried about, because the increase is not just high compared to last year, it's also high compared to the previous years before that. So while much of this increase is simply a story of normalizations, we are also seeing a worsening somewhere. And going forward, we do think this is going to be the driving factor. And there's many reasons for that, and we've sort of covered them already. Why are businesses having a difficult time? Many of them took out much debt during COVID, which they have to pay back. And we are currently working in a high interest rate environment. We're seeing your energy costs being high. Yes, they're lower than last year, but they're still 2 to 3 times higher than they were in 17, 18. So it's still quite a difficult environment to work in. We've already talked about wages. While they may not increase as much as inflation, 4 to 6% is still going to hit your costs. And then lastly, because they're not falling as much as inflation, we will see consumers responding. So we will see people starting to focus more on the essentials. It's your food, it's your heating, it's your fuel, it's the essential clothing you need, which means certain industries are more harder hit than others, and will really see this in the next couple of months once we've reached this normalization stage that I'll say we're generally in right now, and then looking forward is when it can be difficult. And I think if we move to the next slide, we'll sort of see some of this on country levels. Now, obviously, there's some variation between countries, and I can already say quickly that the 4 bottom ones for Sweden seems very, very high. But this is also because it's quite low levels. So this might have gone from 1 to 3. So I won't focus as much on these. Three sectors I'd say is mainly ones to look out for, and maybe we can add one or two is construction. We all know this. We've all seen it. It's making headlines. Construction is a difficult sector, as all the problems we've just mentioned, they're extremely sensitive to. Higher energy, higher commodities, higher input, higher wage, and a labor shortage. At the same time as interest rates increase, which means the demand for especially residential housing will come down. And construction also has the contract structure in which you usually decide on a price months before you execute it, which means you are in quite a risky situation there. So construction is one we are particularly nervous about, but we also see retail sales increases here. This is again because of consumers. Once your real wage fall a second year in a row, you start thinking about where am I going to spend my money? Where do I have a little extra, and where do I need to cut down? And retail is one of the sectors that are very sensitive to this. So that is one we're also nervous about, and we can see it increasing. The last one is hospitality. Less important for Coface, but second order, we need to remember that hospitality also employs a lot of people, which will have second order effects, and they also get food in, which means agriculture, etc., is also dependent on it. And hospitality has had a really difficult time after COVID. A lot of support measures, a lot of loans that need to be paid back. And again, once you start seeing your real disposable income come down, holidays is usually something that will be cut down for many people, which means hospitality sector will have a difficult time. If we move to the next slide, and I can see we're over time, so I will just quickly say that overall, this is a similar picture. Norway's construction sector is still lower than it was before the pandemic, even though we are seeing quite rising figures here. But generally, these three are the sectors that are doing quite difficult. We have other ones. Automotive is very sensitive to metal. Metal is very sensitive to energy, and energy prices are still elevated. And agri-food is obviously sensitive to both energy prices, but also just the supply pressures that we've been seeing due to the war. So there are many sectors who are seeing a difficult time right now, and we're also seeing this in the Nordics. And so I will say, while what we've seen until now is maybe just a return to normal, the outlook looking forward is a bit difficult, because now business actually have to operate in the sphere we're in, and it's a difficult one to operate in.
Yeah, but I mean, the number of insolvencies is sometimes a little bit weird. I mean, especially when we are looking at Denmark, as far as I understood it, every second year they are changing this, cleaning up the statistics, means insolvency numbers are up, but in the end, the effects are lower. So maybe we have a short look at the end on what are the effects.
Yes, that's a very good point. And yeah, Denmark stands out here. Very proud of that fact, but we do have some peculiarities among insolvency figures.
I knew you would say that.
We have the definition of what we call inactive companies, and these sometimes go insolvent at what seems like random times. And if we start by looking at Norway, we see this correlation between the number of insolvencies, the number of companies going insolvent, and the jobs lost within these companies goes more hand to hand. 2020,
yeah, except maybe for 2020, but beside of that, yes, yeah.
Except for 2020, in which we had a few big companies going insolvent, which meant that the effect was higher. It mainly follows a similar path. But if we look at somewhere like Denmark, where headlines have been record level of insolvencies, that's what we've been hearing a lot about. This actually hasn't correlated into numbers of job lost, which means that the companies that go insolvent are either small, micro, or inactive companies. And actually, if you look at the dynamics here, and if you just read the headlines of the number, you'd see a very difficult story after COVID. Big drop in 2020, big increase the year after. But if you look at the full-time jobs lost, that's actually not the real story. These were these inactive companies going insolvent. And if you looked at 2022 compared to 21, the headlines would say insolvencies are falling. But if you look at the jobs lost, we're actually now seeing the effect. And if we look at the 2 first months of 2020, very simply just aggregate that up, we are back to jobs lost roughly similar to 2011, which would be elevated levels compared to what we've seen in the last few years.
You mean here
So-
2023, if we would just take that for 12 months?
Exactly, yeah.
Yeah, okay, so we would be something around 16, and then so we would reach technically 2011. That's how.
Yeah. So the story of it is, if you ask me, we have seen normalization, but the last few years have been unique, and what we're going into now, and we can actually see this, is something closer to normality. And maybe even a worsening of the conditions beforehand, which means that at least if the figures in Denmark are correct, we are back to something we haven't seen for 10 years.
Well, that's our view from our side, and we give back to Mona for the last minutes. Maybe we have some questions here.
Thank you, Christiane and Jonathan. I can see we have one question here. It is, how do you see the financial risk in the Nordics given the latest development in the US and Switzerland?
Well, I mean, Christiane already mentioned some of this. And I would say that what we saw in the US to a large degree is a unique situation. Silicon Valley Bank was in a way, compared to how it was built up, it was a perfect storm for them, but also extraordinarily bad risk management. So in that way, it was quite a unique situation. However, this can have effects despite the fact that this was a unique one. And the perception of bank risk creates bank risk, which means if people fear a run on deposits, it can happen, and we can see the bank runs. And recently Moody's downgraded the banking sector in the US, which actually can also have second order effects. It can raise their funding cost, which means they suddenly have to be more selective in what credit they give, which can have second order effect on the businesses and the consumers who loan. So I will say, while Silicon Valley Bank was a unique one, it puts the financial sector in a difficult situations, and it puts central banks, as Christiane said, in difficult situations, because they now both have to think of inflation, but also financial risk, which is also part of their mandate. So Christiane, I'm not sure if you want to add something to that, because I feel like you also covered a lot of it earlier.
Exactly. So I thought I can completely agree. What I think is really important to remember is that financial markets are a lot about psychology. So even if there is no risk at the beginning, the thought that there could be a risk can lead to a factor that people are taking out their deposits, are having bank runs, and this brings then a company or a bank into risk. So that's the problem. I heard from Pekka already that SVB was really popular in some pension funds in the Nordics. That would be more a thing to think about. If it is so wise to invest into high risk banks, but nevertheless, from the banking perspective, for now we are okay. But this can change again regarding self-fulfilling prophecies. It's all about trust, calm, and psychology.
Yeah. It's similar to inflation. The belief of inflation can generate inflation. The belief of higher financial risk generates financial risk.
Yeah, but then, Jonathan, you should have not shown me the real wage, because before I felt more richer than I feel now. Thank you for that.
Okay, so I think that was the questions we have for today. But I will say that if anybody has questions after the webinar, please send us a mail at nordics@coface.com and we will get back to you. And then over to you again, Pekka.
Thank you. I can see we're running slightly over time, but I would like to thank you, Christiane and Jonathan, and Mona, to you as well, for organizing a nice webinar. First of the year, many to come, and I hope you found it insightful, and I would like to wish everybody a really nice weekend and safe trading. Yeah.
Okay.
Thank you very much.
Thank you.
Thank you, everyone.
Bye.
Thank you very much.
Bye.
Have a good weekend.